Welcome to today's show. Today, we're going to dive into a world that is both exciting and perhaps a little intimidating, the world of financial trading. And within that, the world of algorithmic or automated trading. You might be familiar with that feeling when you start learning something new in this field, and suddenly it seems like an entire ocean of information is crashing down on you. Charts, indicators, strategies. It's easy to get lost among them. Welcome, my name is Lily, and today my conversation partner will be Adam, who has been involved in trading for quite some time. Tell us a little, Adam, how did your journey in this field begin?
Oh, well, that's a very common experience, yes. You try to understand the basics, say the pip, which is the smallest price movement in the Forex market, but almost immediately more complex strategies and jargon come along. It's easy to feel that the whole thing is completely opaque.
That's precisely why today we want to get a clearer picture of what algorithmic trading really means. We'll break down the myths, highlight the essentials, and look at the practical side of it, all through your story. This way, not only will the basic concepts become more understandable, but also the pitfalls that a trader might face.
And why should you pay attention? Because by the end, you will not only understand the basic principles better, but you will also recognize the typical traps that many people fall into. The goal is to save yourself a lot of unnecessary frustration, avoid bad advice, and get a realistic picture of what this is all about. Clear water in the glass, not more murky liquid. That's what we promise.
Then let's start at the beginning. If I'm correct, you found an opportunity that at first seemed like a job advertisement, but ended up taking you in a completely different direction. This was at a so-called prop firm, where the company trades with its own capital, but all with the promise of a paid training course. That's a rather unusual start, isn't it?
Absolutely not the textbook path, yes. We participated in a kind of trading challenge, where along with several others, you tried to prove your results. Well, everyone failed. That in itself is very telling, I think.
Everyone? Wow, that must have been tough. But you're not the type to give up easily. You decided you would learn it on your own, through your own mistakes. You threw yourself into Forex trading, and what do you think you immediately found yourself up against? What did you run into? Let me guess, those classic demons that almost every beginner manual trader struggles with. Overtrading, making decisions about closing or opening positions based on emotions, and, of course, a complete lack of proper risk and money management. Perhaps these?
Bullseye. Exactly that roller coaster. Hope after a good trade, then the painful fallback, followed by another attempt. It must sound familiar to you if you've ever tried trading. The FOMO, the fear of missing out, which makes you get in at the wrong time, or greed, which prevents you from closing a winning position in time, hoping, oh, this will go higher, and then of course it drops back, or panic, which makes you sell too early on a small dip. Classic human reactions, especially when it's your own money on the line. That's exactly why maintaining discipline and consistency in manual trading is so devilishly difficult, especially at the beginning. Emotions, well, they can easily override a rational plan. But I was persistent, and eventually I reached a point where I started to generate consistent, albeit small, profits. And that was the aha moment that made me think. I realized something even more important. Even if my strategy worked, manual trading is incredibly time-consuming. Sitting in front of the computer for hours, watching charts, analyzing, deciding, it can be mentally exhausting. I concluded that there must be a more efficient, a more systematic method, an approach where there is less room for intuition and more for hard-coded logic. And this realization was the real turning point. To overcome the limitations of manual trading and my own emotional swings, well, the most logical next step was automation. I started researching and thus came across the MQL5 programming language.
MQL5. Wait, that's the specific programming language mainly used on the MetaTrader 4 and 5 trading platforms to write so-called expert advisors or trading robots. right?
That's exactly it. This was the gateway for me into the world of automation. I took my own trading rules and strategies that had been proven manually, or at least seemed promising, and started to translate them into code, into lines of code that a computer could then run for you day and night. Importantly, I didn't want everything at once. I started with simpler ideas, learned from my mistakes, refined my code, and only gradually built up more complex systems, step by step.
So you tried to transfer the disciplined mindset you acquired during manual trading into a system that could execute it automatically. It was a methodical approach, absolutely driven mainly by the desire to avoid the stress and time loss of manual trading, and of course, to consistently exploit a market edge.
That's right. And this highlights the fundamental strengths of algorithmic trading. Just think about it. A well-written algorithm is the embodiment of discipline. It follows the rules exactly the same way every single time. There's no hesitation, no, maybe I should do it differently this time, thought.
No FOMO, no panic, nothing like that.
Exactly. Moreover, it can react to market changes lightning fast, within milliseconds, at a speed that we as humans are simply incapable of. It doesn't get tired, it doesn't become inattentive after a long day, it's not influenced by emotions like fear or greed. There's only objective execution according to the established rules. Period.
That sounds almost too good to be true. But as one might guess, there's a but here, isn't there? The question arises, is it really just about setting up the robot, leaning back in your armchair, and watching it make money?
Well, the answer is a very firm no. And this is one of the biggest misconceptions circulating about this. Developing, testing, and fine-tuning an effective algorithm consumes a huge amount of time and energy. It's serious work. And even then, there's no guarantee that it will work forever or that it will even be profitable live. The markets are constantly changing. What worked yesterday might be a losing strategy tomorrow. Therefore, strategies must be continuously monitored, occasionally modified and re-optimized. So algorithmic trading can be an extremely powerful tool, yes, but it requires continuous work, expertise, and supervision. It is absolutely not the passive income source that many imagine it to be. This is important.
I see. So what types of strategies are particularly well suited for automation? Where do the advantages of algorithms really shine?
Good question, because not all strategies can be automated with equal effectiveness. There are some approaches that almost cry out for automation. Trend following is one such example. Here, the goal is to catch and ride the big market movements. The algorithm can disciplinedly stick to the plan and not exit during a minor correction out of panic as a human might. It helps to remove the emotional factor from position management. This is a big advantage.
So its strengths are patience and adherence to the plan. Am I understanding that correctly? And what about strategies that are built on speed?
Well, that's where the advantage is even more apparent. Take scalping, for example. The essence of this is that the trader executes a huge number of small trades for very small profits. Here, speed and costs are more important than anything else. You need millisecond execution speed from the broker and an extremely low, stable spread. This is the difference between the bid and ask price. A tiny delay in execution or a slightly wider spread can easily make the entire strategy unprofitable, ruining everything. Trading consistently with this speed and precision as a human is, well, almost impossible. An algorithm, however, is designed for exactly this.
So the algorithm can not only do the same thing faster and more disciplinedly than a human, but it also enables strategies that would be practically impossible to execute manually. This is an important distinction. And here we can debunk the common myth that you can just buy a miracle robot on the internet, turn it on, and the money will start rolling in from the Bahamas while you're sipping cocktails.
Exactly. Anyone who promises something like that, you should run far away from. Even using a legitimate, well-functioning robot requires serious work. You need to understand exactly what it does, under what market conditions it performs well, what its risks are, and you need to supervise it constantly. And unfortunately, this field is full of scams, with robots that promise incredible, unrealistic returns, often supported by falsified or, and this is a key word, over-optimized statistics.
Over-optimization, that sounds dangerous. What does it mean exactly? What does it entail?
It means that the algorithm's parameters have been tweaked on historical data until it perfectly fits the events of that specific period. On paper, during backtesting, the equity curve looks wonderful, almost perfect, impressive. But the problem is that the robot didn't learn the underlying market logic or general principles, but practically just memorized the past.
Like a student who knows the textbook by heart but has no idea about the connections between things.
A perfect analogy. That's exactly it. As soon as the live market conditions differ even slightly from the historical data set on which the robot was perfected, the whole system collapses. It looks great in the rearview mirror, but as soon as it has to look ahead on an unknown road, it will fail spectacularly. These scams prey on the hopes of beginners who are looking for a magic button for getting rich quick.
And how can one defend against this? How can you filter out the real opportunities from all the, well, junk?
Due diligence, common sense, and realistic expectations are key. Seek transparency above all else. Are there verifiable third-party authenticated results? For example, live accounts tracked on MyFXBook or FXBlue? Does the developer provide a clear explanation of the strategy's logic, its operating principle, and just as importantly, does he also talk about its risks and weaknesses? Look for independent reviews, forums, communities, where other users share their experiences, both good and bad. Pay attention. If something sounds too good to be true, it almost certainly is. This is an old but true saying. Don't focus primarily on the promised profit, but on understanding the logic behind it and assessing the risks.
That seems logical. And you mentioned MQL5. I understand it's more than just a programming language. The entire ecosystem built around it has been a great help to you and many other traders.
That's true. Yes, it's a huge advantage. The MQL5 community and the infrastructure created by MetaQuotes, the developer of MetaTrader, is truly massive. There's the marketplace, for instance, an online platform where developers can sell their own expert advisors, EAs, custom indicators, and other tools. There is also a signal service where you can copy the trades of seemingly successful traders, although caution is needed here too. You have to look carefully at who you follow. And of course, there are the extensive forums, blogs, and articles where a huge amount of knowledge has been accumulated. People share with each other what works for them and what doesn't. They help with coding problems, discuss strategies. It's a kind of collective intelligence that can be invaluable, especially when someone is just getting started in the field. You're not alone with your problems.
That does sound useful, especially for a beginner. Looking ahead, what is the general goal of a trader like you who has already started on the path of automation? Is it just the continuous polishing and refinement of existing robots?
That is often just the first step. The goals are usually broader than that. Developing completely new strategies, possibly extending the activity to other markets or asset classes. Diversification is key. Applying multiple strategies that operate as independently of each other as possible can result in a much more robust and stable portfolio. And of course, for many, the ultimate goal is to achieve financial independence. The freedom not to have to trade for a daily living, but for money to become a tool that allows for the pursuit of other interests and passions as well.
And if we look at it from a broader perspective, where is the algorithmic trading industry itself heading? What trends are worth watching? What can be expected?
Well, the development is incredibly fast. The application of artificial intelligence, AI and ML, machine learning, is gaining more and more ground, not only in development, but also in adaptation. These systems may be able to recognize patterns and make decisions that the human brain or traditional rule-based algorithms are incapable of. In addition, high-frequency trading continues to push the technological boundaries. There, microseconds matter. It's a frightening speed. What does this mean for you, the listener? That curiosity and adaptability play a huge role. Continuous learning is essential in this world. You can't stop. At the same time, the idea of collaboration between man and machine is extremely exciting. How to combine human creativity, intuition, and strategic thinking with the speed and discipline of machine execution. That is the future, in my opinion.
Returning for a moment to the psychology we touched on earlier in connection with manual trading, how exactly does automation help in managing emotions? We said it takes the emotion out, but how does that work in practice?
It works by essentially separating the decision-making process from the execution and stressful market situations. When you develop and test a strategy, you usually do it in a calm, rational state, right? You define the entry, exit, and risk management rules.
Exactly.
And the algorithm executes this plan rigidly. When there are sudden movements in the live market and your inner voice whispers, sell quickly or buy more, this is going to break out, the algorithm stays true to the original, calmly developed plan. You create a framework in which, and this is important, you trust. This acts as a buffer against your own fears and greed. Of course, this only works if you truly trust your system, which was preceded by thorough testing. You can't just trust it on a whim.
That's an important point, yes. But the algorithm itself is only one part of the machine. Choosing the right broker is also critically important, right? What should you look out for, especially if you want to run automated strategies? What do you advise?
Absolutely critical. In fact, perhaps one of the most important things. Don't just look at the big name or the flashy marketing, dig deeper. The spread. The difference between the bid and ask price should be consistently low and stable, not just on average, but also during important market events. That's the key. The execution speed is vital, especially for faster strategies. Here, milliseconds really count. Check the swap fees as well. These are the interest payments you either pay or receive for holding positions overnight. These small costs, when they add up, can easily eat away at profits, especially if you have many trades or hold positions for the long term. A good broker is reliable, fast, and cost-effective. These are the aspects to look for.
All right, so you have the strategy, you have the broker. Before going live, there's testing. We hear a lot about back testing and forward testing. What is the difference between the two, and why are both necessary? Isn't one enough?
No, it's not enough. In backtesting, we run the algorithm on historical market data. This shows how the strategy would have performed in the past. It's excellent for quickly checking the basic idea of the strategy, filtering out gross errors, and for the initial setting of parameters. But, as we said, past performance is no guarantee of future success. And this is where forward testing comes in. This is also called paper testing or demo testing.
So this happens in the present, not the past.
Exactly. In forward testing, we run the algorithm in real time with live market data, but not yet with real money or only with a very small stake on a demo account. This really shows how the strategy performs under the current, actual market conditions, including spread fluctuations, slippage, and other factors that backtesting cannot always perfectly simulate. Both the historical check and the live simulation in the present are indispensable before you risk serious capital with an automated strategy. This also helps to avoid the trap of over-optimization mentioned earlier. It is a very important step.
Understood. So if we were to summarize the most important message of our conversation today, algorithmic trading can be an extremely powerful tool, but perhaps it's even more important to clarify what it is not. What is algo trading not?
Well, it's not a magic wand or the Holy Grail. It's important to emphasize this. It does not guarantee success without learning, a deep understanding of the markets, and continuous adaptation. It is a sophisticated tool in the hands of the trader, not a self-propelled money-making machine. This misconception must be dispelled. A knowledgeable, disciplined trader uses it to execute their carefully crafted and tested strategies faster, more precisely, and free from emotional influence. So the algorithm enhances the trader's abilities. It does not replace the trader's knowledge, judgment, and continuous work. That's the bottom line.
What would you say to someone who is now considering getting into this world, whether Forex in general or algo trading specifically? What should be the first piece of advice?
Persistence and a commitment to learning are the most important, and have realistic expectations. This is perhaps the second most important. This is not a get-rich-quick scheme.
but a profession, a skill that must be mastered. You have to dedicate time to it. It's a long-term journey. It's full of learning, challenges, and sometimes you have to face failures. But with the right attitude, mindset, and a commitment to continuous improvement, it is possible to achieve success.
So for you who are listening to us now and perhaps planning your first steps, accept that there will be a learning curve. Not everything will work out immediately. Get to know the tools, understand the risks, and most importantly, stay grounded in reality. The potential in automated trading is real, but it rewards diligence, curiosity, and disciplined work, not chasing fantasies.
You've summarized it very well. And perhaps one final thought for the road, something to ponder. What if the most powerful trading approach is not just using robots, nor is it purely relying on human intuition,
But the intelligence and experience to recognize when and how to combine the strengths of both most effectively, the synergy of man and machine.
That's exactly what I was thinking, something that you can think about as you plan your own path in this exciting but challenging field. Thank you very much for joining us on this thorough exploration. We hope we have managed to provide some clarity on the world of algorithmic trading.
And before we close, write in the comments what topic you would like to hear about in the next podcast. See you next time.